Hello and welcome to another episode of From Inside the Studio. Nick Royer here, and today we're going to talk about the crystal ball that some people say exists, but no one can seem to figure out how to use it. Or maybe the truth is that crystal balls really don't exist except for in the movies. Now, okay, I wanted to show you something, and I was quite interested in this when I saw it. Same website, same day, Yahoo Finance. So I go to this website a lot just to see what prices are doing, and I don't really go to it much for maybe useful information, but today you're going to see why. So here's an article about an expert that I'm going to say in quotes, of course, who says that the S&P is still going to fall. It's going to overshoot its historic floor. Brace yourself. It's headed down even further. Now, that's what that one says. Same website, same day. Don't be duped by doomsayers, JP Morgan says. The S&P will rebound to 4,900. Here are three stocks it's using to bet on that bounce. Now, here's the reality. No one knows. Two different articles on the same day saying completely different things. What that tells me is no one has any idea. Everyone has a theory, and some say they have a crystal ball, but here's one thing that we can agree on is the market is volatile. It always is, which is why you're diversifying. Now, right now, there's times, this year when it may seem like diversification is not working, but it is. If you're in what's known as a balanced portfolio, and that's the one that is probably used in most of those 401ks, the 401k companies, where you're mixed between stocks and bonds. So again, a balanced portfolio, one of the most popular ones out there where you're in the 401ks, where you're mixing stocks and bonds. It's one or the other. Stocks and bonds are mixed. Sometimes you have higher stocks and less bonds, but it's usually balanced between the two. And that portfolio this year has been down, but not as much as an all equity portfolio. If you're in one of those all equity portfolios, you're down the most year to date. And if you are diversified across many different asset classes, like say investments that are principal protected, with investments that are in the market that do have market risk, then you're probably down far less. Whenever we are creating financial plans, we factor times like this into that plan. We never assume at any point that, or any point in time, that a client will get the same return every year. And we never assume that each and every year will be an up year, with the market never, ever, ever, ever going down. That's something that's just never happened, and it's not something that's going to happen in the future. All that we can do is build a house of brick as opposed to a house of straw. You probably remember that from the story of the Three Little Pigs. So whenever the market is volatile, or whenever we hear things on TV about all the crazy things going on around us, or whenever we read things like those articles I just showed you a minute ago, that stuff can make us do not so wise things. We can get tempted to move all the money out and put it underneath the mattress until the noise calms down. But the problem is we don't know when that's going to be. There's always going to be fear. There's always going to be bad news. There's always going to be market increases and market decreases. Markets tend to act in a rather fickle manner. One thing I want you to keep in mind has to do with recessions. Are we in one? That's a question that people are asking a lot of. Well, by book, the book definition says we are 2 quarters in a row of negative GDP, gross domestic product. It happened, and so I guess we are, although Washington has claimed that we aren't in a recession, but the book definition says we are. But here's something you should know about recessions and equity markets. Oddly enough, they don't go hand in hand. Typically what happens is the market goes down before the recession in anticipation of the recession. And then the recession usually isn't quite as bad and the markets tend to rebound. Now, you can't really learn a lot from that, but what I want to, I guess, emphasize to you is that the news will never tell you what's really going to happen. It doesn't know. We have to rely on history to be our guide. And if history is any guide, it's going to say that we're going to have some volatility, but eventually we'll work out of this, we'll work our way through it. Now, what logic is, that's of course logic talking, right? But your money is very emotional, and it should be. It's your money, it's your retirement. Market declines can cause people to really follow emotion versus the math. And what we try to do is create plans that help us follow our math over our emotions. But with inflation still high and the Fed saying they will likely raise interest rates a few more times this year, these two obstacles are likely going to slow things down over maybe for a little bit longer, and will slow down any longer term market rebound. So volatility will continue for probably, I'd say, a little bit longer while this all gets worked out. And for the most part, portfolios will be adapting in concert with what the market is doing. If you have a portfolio that's designed to do that, which is what we typically prescribe, is to have portfolios that can mirror and mimic what's going on in the economy and adapt and adjust. And so hopefully that's happening where you're adapting to a move with what the market is doing. At times, that means maybe becoming more defensive, like it has been over the past couple of months. And that can mean, and then there's times where it can mean being more offensive. When interest rate increases slow down and inflation begins to stabilize, then we're likely going to see the market starting to resume their upward trend. But this is something we are letting the math guide versus letting our emotions guide. It's easy to advise what to do when the markets are up. But in down markets, that's where we need to have a solid plan that we can stick with. All we need is to have the discipline to stay strong and stick with that plan. And we've been through worse times than this. It's just part of the process. But I think you can see that if we're going to go to the internet or to news for answers, well, we're going to hear things like the market's going up, and then a few minutes later, the market's going down. It's never going to give us any answers. It's probably just going to confuse us more and take us off track. So stay true to your plan if you have one. If you don't have one, reach out to us. And reach out to us if you feel that you need an adjustment to your plan, or if you don't have one at all. Again, like I said, now is a great time to get that fixed. But until next time, don't forget you can check us out on Facebook, YouTube, Twitter, Instagram, and we'll be back with more thoughts and tips coming up on our next video. But until then, take care everybody and have a great day. Bye now.